Financial Literacy is an educational program which airs on Waves 1170 every Sunday night at 9 p.m. Hosted by Hubert McIntosh, a CPA and member of SOFA, the Society for Financial Awareness, with the number one goal: assist individuals to take charge of their personal finances. Please join us every Sunday night at 9 p.m. on 1170 a.m. or via your smartphone app, Waves 1170, or on the internet at waves1170.com. Waves 1170. 1170 a.m. It's Sunday night in the Caribbean month. Hubert McIntosh is a member of the Society for Financial Awareness, and he's the man. Financial literacy provided by Hubert McIntosh, CPA. Financial literacy. Control your financial status. Here's your host, Hubert McIntosh, CPA.
Good night, good Sunday evening. Good for you to join us tonight. Tonight we have a very, very exciting show for you. Tonight we're going to be talking about qualified plans. On previous shows, I've shared with you that some are related to you, some may not be, some may be related to your cousin, your brother, your sister, your mother. But tonight's show is related to everyone. So it's Sunday night, we're in school. So I encourage you, get your pen, get your paper, because you're gonna need to take some notes. I'm gonna share some things with you. Some you may know, some you may not know. So, just get ready for that. The phone lines are open. It's 954-792-1170. 954-792-1170. I'm Hubert McIntosh, your CPA, a member of SOFA, the Society for Financial Awareness. SOFA's goal and mission is to help eradicate financial illiteracy in America, one community at a time. And we're starting with this community. So I thank you for joining us. The website is financialliteracy.info. Financialliteracy.info. You can go on there. You can make comments. You can give us your questions. We will address them. You can email us at support@financialliteracy.info. Support@financialliteracy.info. So in continuing the theme of bringing you financial literacy, tonight's topic is a very interesting topic, as I've said before, qualified plans. And it's a part of developing your personal economic model. Because remember, I shared with you from the inception is what we're doing. The goal here is that we're helping each of you to develop a personal economic model, because it's not a one size fits all. So, but with education, you'll be able to structure your personal economic model. We have shared with you in previous shows about wealth transfers. We have spoken that there are 5 areas of major wealth transfers. We have covered mortgages. We have covered taxes. Last week we shared about college planning. And tonight we're going to be sharing about qualified plans. So with that being said, what are qualified plans? So let's give you the definition before we go further. Qualified plans, and sometimes you hear the word, people are not even sure what the word qualified means. It's qualified to be invested with pre-tax dollars. In other words, the government allows you to invest your money without taking the taxes. So that should trigger something there in your mind right off the bat. The government allows you to invest your money without taking out any taxes. So I'm going to give you a little history lesson also. How did qualified plans come about? This country is 240 years old. 1776 to now, 240 years old. Qualified plans came out in 1976. That's 200 years after this country was already formed and operating. So the question is, why? What happened? So the history of it is, what happened? What caused qualified plans to be enacted by Congress? Prior to 1976 in America, most individuals, when you work at a company for any long period of time, you would have a pension. Whether it's a motor company like Ford Motor Company, Chrysler, or whatever. Most companies that are not necessarily small companies, individuals could have looked forward to a pension. In the mid-70s, something started happening. Interest rates started to increase, and the lobbyist went to Congress and says, you know what, our employers cannot afford these pensions anymore. They cannot afford to, because back then the companies had to be saving, they had to put money aside so that they can pay the individuals when they retire these pensions. So they lobbied Congress in the mid-70s, and Congress says, okay, if we're gonna help the business people by taking away or allowing them not to have a pension, we have to have a balance. We have to give the people something. So in enforce, what was enacted then was IRAs, individual retirement account, get 401ks, and those things came on board. So as you notice, anytime you hear anything about tax planning, qualified plans, and you hear a number, any number that you hear, it's a part of the Internal Revenue Code. So 401k is a section of the Internal Revenue Code. IRA, you hear it as IRA, but IRA is 408A, 408A, 408B of the Internal Revenue Code. You have for non-profit and government entities, they have 403B. They have 457. That's for government agency. You have 457. You have SEP IRA. You have Simple IRA. So all of those are qualified plans in that the government allows you to invest in it without paying any tax. So let's stop and think about that for a minute. A lot of times, someone will say, well, I'm investing in my 401k. And as a CPA, I will ask them why. And the answer I get sometimes is, oh, the company allows it. All right. So why are you investing in it? And sometimes people just don't have the answer. So tonight we're going to take a deeper dive into it. We have spoken about tax planning in previous show, but tonight we're going to talk about qualified plans. Why do people do it? And we're going to share some of the misconceptions, because there are some misconceptions there. And as I said, there are things that you're going to hear tonight that you never heard before. So I'm going to introduce you to a saying that you're going to hear me use frequently. So the lines are still open, 954-792-1170. We're here to take your calls, 954-792-1170. So as I was saying, I'm going to introduce you. One of the phrases I'm going to introduce you to, because some of the things you may not know. So the question I'll ask you now, and you can think of this and reflect on yourself. If what you thought to be true is not so, when would you want to know? So think about that question for a minute. If what you thought to be true was not true, when would you want to know? So tonight, I'm going to share some of those stuff, and they're going to be things that you thought was true, but you're going to find out that they're not true. So let's break down qualified plans. So qualified plan, someone will say, well, I have a 401k, I have an IRA, and they'll say, well, I'm doing it because I am saving taxes. Reflect on that for a minute. I'm saving taxes. Many people think that. So, but I'm here to tell you, you're not saving taxes. You're deferring taxes. Let's use another word. Let's use a more common word for deferring. You're postponing the taxes. You're not saving it. You're just postponing it. So qualified plans does two things. It's defer the taxes and it defers the calculation of the taxes. And I'm going to put some numbers. I'm going to put some numbers to that so that you can relate to it instead of just sharing with you the theoretical part of it where you can understand it. Another thing that qualified plans do, someone will say, well, it's for my retirement. It's for my retirement. And all of those are good things. So I'm not here to tell you that qualified plans are not good. That's not what we're saying. What we're saying, though, I want you to be aware of what you're doing. Because if we're helping you to build your personal economic model, we're going to use an example. It's like qualified plans is a tool. It's a financial tool, or different terminology, it's a financial vehicle. It's like a carpenter or a builder may have a toolbox or a toolkit. They have different tools in the toolbox. So a carpenter may have a hammer, he may have nails, he may have a screwdriver. And so based on the project that he's going to work on or the particular task, he may use a particular tool. So you can see where someone could use a hammer to beat something, hit something, while an hammer is made to nail something. So sometimes you can have a tool that you're using for something else that it's not built for. So we're gonna get into it and talk deeply about it, and we're gonna share with you some number examples. On the other side of the break, the clock on the wall, it's telling me that I have to break for a short commercial break. So I want you to stick and stay with us. We will be right back on the other side. So thank you. Don't move that dial. We'll be right back.
Get up with Lifeline Tax Incorporated for tax preparation and tax planning services. Lifeline prepares all forms of tax returns: 1040 personal, corporate S&C, partnership, trust returns, and all other federal forms. Go to lifelinetax.com or call 561-244-0062. Contact us to help you with your lifeline to a better tax future. Go to lifelinetax.com or call 561-244-0062. Meet Bob.
Hello, everyone.
Bob searched and searched for insurance, but grew frustrated with the high number of options.
Oh, no. What am I going to do?
Then Bob contacted the McIntosh Insurance Agency.
Bingo.
The McIntosh Insurance Agency helped Bob get affordable insurance that fit his unique needs.
Oh, Oh, I'm happy I found this guy.
Be like Bob. Go to McIntoshinsuranceAgency.com or give them a call at 561-300-2444.
You won't be sorry.
Remap Accounting Firm offers a wide variety of affordable accounting and tax services. We can help you develop your budget and manage your cash flow. We help families and businesses save money on taxes. Listen to our satisfied customers.
It's good to know that the success of our business is important to Remap. We're confident that Remap sees us as more than just a client.
Contact us at remap.com or call 561-623-0241. Would you like your business to maximize its return on investments? Then contact Wealth Management and Distribution Group. Wealth Management and Distribution Group will help you minimize your tax liabilities. It doesn't matter if you're an individual, an entrepreneur, or a small business. Protect your assets for you and your loved ones. Maximize your return on investment with Wealth Management and Distribution Group. Get more information at WMADG.com or call 954-701-4730.
Welcome back. Welcome back. Thank you for sticking and staying. Okay, on the other side of the break, we're going to take a deeper dive into qualified plans in what does it mean when we say we're going to postpone the tax and we're going to postpone the calculation. So let's put some numbers. Let's put some numbers to it. And the phone lines are still open. 954-792-1170. 954-792-1170. So let's put some numbers into it. So here it is. You're putting $1,000, and we're just using this as an example. You're in a 30% tax bracket, and you put $1,000 into a 401k, or you put it into an IRA, and you're saying, wow, great, I'm putting $1,000 in, my money will be growing, and I am saving taxes. Oh, many of you, search yourself there, think that when you put that $1,000 in, you're saving taxes. But if you're in a 30% tax bracket, what you're doing is postponing paying 30% of tax. So you have $1,000 in, but only $700 of it is yours. $300 of it is the IRS or Uncle Sam, because you are in a 30% tax bracket. So here it is. You're saving in this vehicle that $700 is yours, $300 is Uncle Sam. And you're saying, well, it's great because if I get to save or get to postpone, then my money can grow more. But let's evaluate that statement. My money can grow more. Remember, of that $1,000, only $700 is yours. $300 is the IRS. So the question is, when will you pay the tax? Okay. All right. So let's look at it this way then, using another example. So you said to the government, okay, I don't have to pay the taxes. So in other words, the government is giving you a loan. They're giving you a $300 loan. But if you go to a bank, whether it's Bank of America, Wells Fargo, or wherever you go, and you take a loan, there are two questions that you're going to ask the bank. You're going to ask, what interest rate will I be paying? And how long is the term of the loan? That's what everyone does when you're getting a loan from a bank or a different financial institution. So if we all do that when we're getting a loan, why is it we do it differently when we're dealing with the government? Because here it is, this $1,000, you owe the government $300, but the government says to you, okay, I don't know when I want back this money. You can keep this money forever until I'm only gonna force you to pay me back when you reach age 70 and a half. You can keep that money. Keep that money because right now I'm doing good. I don't need that money. But once you get to 70 and a half, I am gonna need that money. And you ask the government, you say, so what's the interest rate? Government says, well, I don't really know the interest rate right now, but when you get to 70 and a half, I'll let you know. How many of you would really take a loan from someone where they're telling you, well, when it's time to pay, I will let you know the interest rate? Most of you would not cash that check. You would not cash that check because the uncertainty of the interest rate would change your mind. But it's the same thing we're doing with qualified plans because we don't know what the interest rate is going to be. If you're in a 30% tax bracket now, which of us know what the tax bracket will be 5 years from now, 10 years from now? In fact, which of us even know what the tax rate will be in 2018? We don't know. So tax is an uncertainty. Tax rate is an uncertainty. So if we're making plans with an uncertain factor in there, because if the tax rate is an uncertain factor, but you're making a long-term plan with an unknown factor, which is X, then it's going to be pretty difficult to solve that equation because X is an unknown and you will not know what X is until you get to that time when you're going to take out that money. So, all right, so we identify a couple of negatives here. But listen what else goes along with this. So take a person. Let's just use an average. Let's use a 40-year-old. Let's just use a 40-year-old as an example. So a 40-year-old person says, okay, they're going to invest and they're going to put that money in. And, they're planning to where they're going to do it for 25 years. They're going to retire at 65. One of the conditions that these qualified plans have is that you cannot touch that money until you're 59 and a half. Think about that. So here's this 40-year-old, put this money in, don't know what the interest rate they're going to pay, but they cannot touch that money for 20 years. Think about that. Think about that for a minute. So if you have an emergency and life does happen, you have an emergency and you need some money, if you attempt to touch that money before 59 and a half, you're going to pay 10% penalty and you're going to pay 20% tax. So if you want $10,000 off your money is going to cost you $3,000. So you stop and you look at that and meditate on that for a minute. So you have the part, you don't know what the interest rate you're going to pay back. And that's the tax rate I'm talking about. Then you have the condition that you cannot touch the money. And you're like, but this is what they told me on the job to do. And you stop there. This is what they told you to do. But you have to stop and ask yourself, because governments are good, but when government delay you paying something, then there are conditions. I won't use the word catch. I was tempted to use the word catch, but there are conditions. Because back to that $1,000. If you owe $300 of that $1,000, if they said, well, when you're going to pay the tax, you owe $300, that's not so. So let's say that $1,000, wow, in 20 years, 30 years, you did so good. That $1,000 turns out to be $50,000. So here you are now thinking, wow, I got $50,000 in my account. But guess who you forgot? You forgot about your uncle. 30% of that money is his. So you are bragging and you're thinking that you have 50,000. You only have 35. If, and I'm putting the if in capital letters, if the tax bracket is 30%. If the tax bracket is 30%, then you owe Uncle Sam 15,000. But here's the part that most of us don't want to hear. What if the tax bracket is 50%? Think about that for a minute. This 50,000, you could have paid $300, but because you thought you were getting a tax savings, that $300 cost you where you're paying $25,000. So think about that for a minute. And this is why we have this show, because it is about financial literacy. And this topic happens to be one of the number one topic that people are illiterate. People are illiterate in it because they're doing it, they're putting money in it, and they don't have the understanding of what it does. So we are here hoping that we can shed some insights, we can share some things with you, whereas if you're doing it, let's know why you're doing it. And another person may say, well, what are my alternatives? Well, the same Internal Revenue Code, which has over 80,000 pages, as other vehicles. It's just for you to explore the vehicles. So you have another, I'm going to introduce you to two sections. You have section 101A of the Internal Revenue Code. You have section 7702. All of these are ways that you can invest your money, but that is called non-qualified. You see, that's the difference. So you have qualified and you have non-qualified. The difference is qualified is that you can invest with pre-tax dollars. Non-qualified, you're investing with after-tax dollars. So there are times when it's good to invest with pre-tax dollars, but you have to know when. So I want you to stick and stay with us. This is the clock on the wall. The time is just flying, and I hope you're taking notes. Continue to take your notes. We're going to break for a short commercial break. We will be right back.
Trying to do it with a headache? Now that's just unfair. This tax season, cut out the confusion and reach out to the fine folks at Lifeline Tax Incorporated. Lifeline Tax was established with the vision to serve their clients with a holistic approach to their tax preparation needs. Lifeline Tax provides all forms of tax returns and offers superior client services in small business strategy development, charitable tax planning strategies, Social Security tax reduction strategies, Roth IRA conversion strategies, and more. Whether you're a professional, small or medium-sized business, or just someone who's looking for a little extra personal help this tax season, Lifeline Tax has got you covered. For more information, visit us on the web at lifelinetax.com or call us at 561-244-0062. That's 561-244-0062. Since 1963, Macintosh Insurance has been proud to provide insurance and financial solutions to 1,300 people and businesses. Whether you're looking for life insurance coverage, health insurance, Medicare, legal insurance, long-term care, or annuities, Macintosh Insurance will remain committed to building a solid relationship with customers through practical solutions and unmatched service. To learn more about us, visit our website at Macintoshinsagency.com or give us a call, 561-300-2444. We'll talk to you soon. Are you looking for an accounting firm that you can trust? One with a client-first philosophy? Well, don't worry. Every little thing is going to be all right. With a dedication to professionalism, responsiveness, and quality, Remap offers a variety of services, from bookkeeping and tax preparation to payroll services, IRS problem resolution, and retirement planning. Don't play games when it comes to your money. Go online and search remap.com. That's RE-MMAP.com, or call us at 561-623-0241. For more than 30 years, Wealth Management and Distribution Group has been helping people save, grow, and protect their money. Wealth Management and Distribution Group was formed with the purpose of helping individuals, entrepreneurs, and small businesses to maximize their ROI by minimizing their tax liabilities. Protect your assets and the assets of your loved ones. Visit WMADG.com for more information. That's WMADG.com, or give us a call at 954-701-4730.
Welcome back. Welcome back. Thank you for staying with us. The phone lines are still open. 954-792-1170. 954-792-1170. We're here to take your calls. On the other side, I know I dropped a couple of bombshells, which I'm gonna elaborate or give you a better explanation. I mentioned to you, what if the tax rate, you're deferring or you're postponing the taxes when your tax rate was 30%. And I said to you, what if the tax rate gets to 50%? And I know sometimes that can be a shock to people because you're thinking, well, that's not possible. Well, the tax history in America, which has been tracking since 1913, the highest tax rate we ever had in this country was 93%. Yes, 93%. Think about that for a minute. And someone will say, wow, I never heard that. Well, remember the phrase I introduced you to earlier. If what you thought to be true turned out not to be so, when would you want to know? You see, the tax history in America is very interesting, and if you don't know it, it can become confusing. Initially, when this country was formed in 1776, individuals didn't pay tax. Individuals didn't pay tax. There were corporate taxes in America. The first time individuals started paying taxes was 1865. When after the Civil War, the government thought of, well, if we can help to rebuild the country by installing a small tax. So what happened is that individuals start paying taxes. But what happened then was the threshold was high. When I say the threshold, it was like the individuals who had a high income would pay tax. So the lower class, the middle class did not have any tax burden per se. When 1913 came around, and if you remember 1913, the turn of the century, we had the Industrial Revolution and we were getting ready for the First World War in 1914. What happened? Anytime the government needs extra money, folks, I just want you to be aware. Anytime, and this is not a political statement, anytime the government needs money, the easiest way for a government to get money is to tax the people. To tax the people. So in 1917, after the First World War, the tax rate at that time was 67%. Yes. So here was this tax which was supposed to be just temporary. But when the government saw that, wow, man, if we can continue to get some, so what happened? They started lowering the wage threshold. So for instance, individuals with smaller wages now was paying taxes, and the rest is history. Taxes have gone up and down. After World War II, tax went up to 91%, and it has been like that where it float, and contrary to popular belief right now, the tax bracket that we have in America now is one of the lowest since 1913. So I just want you to be aware of that. If you know what the tax rate is going to be, then your decision can be great if you know. But as far as I know, nobody knows what the tax rate is going to be. The phone lines are open, 954-792-1170, 954-792-1170. I'm not sure if some of the information, what I'm giving you, is shocking you. That's why you're not calling, but we're here to address your questions. Okay, so we talk about the tax. So I think we have covered the point where we are not necessarily saving taxes. So what is it then? When someone says save taxes, it's an apparent tax savings, because no one can tell you it's a tax savings. The only way you can know if it's a tax savings, if you can tell me that what the tax rate will be in 20 years. Because if you defer the tax at 30%, when you're paying 30%, if in 20 years the tax rate is going to be 10%, yes, you win. Yes, you win. But if the tax rate is 50%, then you lose. So basically, no, so you're going 50-50 now. You're rolling the dice. Well, I believe if you want to roll the dice, we have made places for you to roll dice. That's what they do in Las Vegas. That's what they do in Atlantic City. You should not be rolling the dice with your financial future. You know, if you're into rolling dice, do it at the places that allows that. But don't take that chance with your future and your family future, and you run this risk of transferring your wealth unnecessarily and unknowingly. That's what you're doing in that case. So the next question, and let me address an objection that I anticipate that may be out there, where I've heard the statement when someone says, okay, but my company is matching my 401k. Okay, let's talk about that. That can be good, and it also can be bad. So you're like, wow, I'm messing with your head again. It can be good, it can be bad. When can it be good? Let's go back to numbers again. If you're in a 33% tax bracket, 33% tax bracket, and your employer is matching you 50% of that $1. So if you contribute $1, your employer gave you 50 cents. So that means you now have $1.50, right? You put $1, your employer put 50 cents. So you know $1.50. If you're in a tax bracket of 33%, the tax you owe is 50 cents. So look at that. So the 50 cents that the employer gave you is just to pay the tax. Think about that. Think about that for a minute. And I know this statement is messing with a lot of your minds right now, because you have never heard it that way. Because you thought that the money that your employer matched was, I've heard people use the term, oh, I'm getting free money. I'm getting free money. I am getting a 50% return on my money. No, you're getting 50% of the contribution, not 50% of your money. So think about that for a minute. You're getting 50% of the contribution, not your money. So what happens as your money increases now, then that 33% tax is still owing to the government, and they are not saying they just want the 33% tax on the $1.50. They want the 33% on the total amount of money that's accumulated. So let that soak and think for a minute. So with the deficiencies, whereas you cannot take your money, you don't know what the tax rate is, And if you have an emergency, you don't have access to money. So ask yourself, is that the best way to do it? I'm going to introduce you again to another topic, but you guys are not calling. The number is 954-792-1170, 954-792-1170. So let me introduce you to another phrase, because I told you, I prepped you that we are having Sunday school tonight. I told you to get your pen, get your paper. So if you have not been taking notes before, I'm going to introduce you to another terminology that you may have heard, you may not have heard it, but I'm going to introduce it to you now, because we're talking about the tax, the deferring of the taxes. I'm now going to introduce you to a term called opportunity cost. Opportunity cost. What is opportunity cost? Opportunity cost is the cost of something that you use something for. Let me break that down more. If you pay 50 cents in tax, whether it's 50 cents, $50, $500, if you pay 50 cents in tax unnecessarily, it's not just 50 cents. The cost is not just 50 cents or $500. It's what that $500 could have earned you. So it's not just, so like we talked last week about the sticker price of something. You go and you buy a car and you talk about the sticker price. The sticker price is not necessarily the cost, because if you buy the car for $20,000 and you're thinking the cost is $20,000, the cost is more than $20,000. It's the opportunity cost. So I want you to remember to factor the opportunity cost in your decisions. So all I'm saying in summing up this, you just need to make these decisions with literacy, and there are ways to get it. We're here for you. Where we have brought this show on, we have created a website, financialliteracy.info. We have an email address. You can email us, support@financialliteracy.info. So the phone lines are open, 954-792-1170, 954-792-1170. Wow, this time is so flying. The clock on the wall tells me I have to go pay some bills. I have to break for a commercial break. So stick and stay with us, because we're coming down the home stretch. Just hold that dial. We will be right back.
Lifeline Tax Incorporated for tax preparation and tax planning services. Lifeline prepares all forms of tax returns.
1040 personal, corporate S&C, partnership, trust returns,
And all other federal forms. Go to lifelinetax.com or call 561-244-0062.
contact us to help you with your lifeline to a better tax future.
Go to lifelinetax.com or call 561-244-0062.
For more than 30 years, Wealth Management and Distribution Group has been helping people save, grow, and protect their money. Wealth Management and Distribution Group was formed with the purpose of helping individuals, entrepreneurs, and small businesses to maximize their ROI by minimizing their tax liabilities. Protect your assets and the assets of your loved ones. Visit WMADG.com for more information. That's WMADG.com, or give us a call at 954-701-4730.
Meet Bob.
Hello, everyone.
Bob searched and searched for insurance, but grew frustrated with the high number of options.
Oh, no. What am I going to do?
Then Bob contacted the McIntosh Insurance Agency.
Bingo.
The McIntosh Insurance Agency helped Bob get affordable insurance that fit his unique needs.
Oh, I'm happy I found this guy.
Be like Bob. Go to McIntoshinsuranceAgency.com or give them a call at 561-300-2444.
You won't be sorry.
Remap Accounting Firm offers a wide variety of affordable accounting and tax services. We can help you develop your budget and manage your cash flow. We help families and businesses save money on taxes. Listen to our satisfied customers.
It's good to know that the success of our business is important to Remap. We're confident that Remap sees us as more than just a client.
Contact us at remap.com or call 561-623-0241. Would you like your business to maximize its return on investments? Then contact Wealth Management and Distribution Group. Wealth Management and Distribution Group will help you minimize your tax liabilities. It doesn't matter if you're an individual, an entrepreneur, or a small business. Protect your assets for you and your loved ones. Maximize your return on investment with Wealth Management and Distribution Group. Get more information at WMADG.com or call 954-701-4730.
Welcome back. Welcome back. Thank you for sticking and staying with us. The clock on the wall is running like a jackrabbit. You know, we are in the home stretch, but I just want to remind you the phone number is 954-792-1170, 954-792-1170. We're here with you on Sunday nights from 9 to 10 p.m., but you have 24/7 access to us. We have the website financialliteracy.info, financialliteracy.info. We have the email support@financialliteracy.info, support@financialliteracy.info. So even though we are only with you 1 hour per week on the radio, you have 24/7 access to us. We just got a comment on the website from a listener. It says that making a comment says somebody holding on to your money then making you pay a penalty is absurd. Oh my gosh, that is one of the comments we have gotten from one of the listener. So if it just shows that some of you there are thinking of that, because here it is, your money. Hold on to your money, and you're paying a penalty to get your money. So we're in the last quarter of the show, so it may sound like, wow, I'm just throwing gloom and doom out there. No, it's not necessarily gloom and doom. I'm just sharing and just want you to be aware of some of the wealth transfers that you're doing, and some of it is unknowingly, and also unnecessarily, because the same vehicles that the government created, the government created 401k, 408, 403, 457. There are other vehicles the same government has also created. 101A. Some of you can look up that 101A. Then there's also 7702. These are all internal revenue plans. But so you may ask yourself, so why are some known more than others? It's all about marketing. It's what has been marketed. Why do you know about some things more than the other? It's just the same kind of thing. So I just want you to be aware of that. So we have spoken about the savings, the apparent tax savings. We have spoken about opportunity costs. We have spoken about where the funds are not accessible during your accumulated years. So these are some of the stuff you need to think about in terms of wealth transfers, So I understand that we have a caller on the line. So caller, you are on the line.
Yes, good night. I have a question. Are there better options than your 401k or your company retirement plan that you can put your money into?
There are, and that's a great question, caller, in the sense that whereas it's not a one size answer to say there are better options. So I'll use a different word than better. I'll use the word alternative. There are alternative investments. So it all boils down to what it is that your plan is. What is it that you're hoping to achieve? Is it tax savings? Is it retirement? And when you look at those things, is that are you willing to deal with the penalty or the consequences of a 401k? So it's not necessarily saying there are better, but there are alternatives.
Okay, then. Thank you.
You are welcome. So go on the website, our website, financialliteracy.info. You can make your comments there. We have been getting comments on the website, so we thank you very much for participating. You know, you can email us, support@financialliteracy.info, support@financialliteracy.info. So as a caller asks about if there are better vehicles, and I refrain from using the term better. I'm not saying to you that 401k is bad. Don't get me wrong. I'm not saying qualified plans are bad. So, but I'm just providing the education to know what you're dealing with. It's like traveling. If someone is going to travel north from South Florida, one person may say, is it better to travel I-95? Is it better to travel the Turnpike? None of them is really better per se. It's what's the person's goal. Does the person want to get there faster? That's one of the things. You know, you have different types of drivers on either highway, but there's a cost. There's a cost. You can get to Jacksonville via I-95 and you don't pay any tolls. But you can also get to Jacksonville via the Turnpike, but you're gonna have tolls. So it boils down to your choice. What is it? So if you don't have the money to pay that extra in toll, then yes, 95 is gonna be a better route. But if you may want to go faster, sometimes someone may say, well, the Turnpike is definitely faster. But I would also hesitate to say that, because what if the day that you're taking the Turnpike, there's an accident on the Turnpike? So you see, what happened is these are choices you're making. But if you are aware of the pitfalls, if you're aware of these roadblocks, then you can make wise decisions. You know, there are investment vehicles. So if someone says, well, I'm looking for a particular rate of return, then whichever financial advisor that you're talking to, if it's rate of return you're looking for, then that person can shop the market for you and talk to you about rate of return. But just like we just spoke about, if you get a higher rate of return, there will be a higher risk. So if someone doesn't care about the risk, then they may shoot for a higher rate of return. Another person may say, well, I cannot afford to lose any money. Then that person may have to give up a couple percentage points. So for instance, instead of getting 6%, you may be able to get 4% with less risk. So the goal and the idea is that whatever you are doing, have a plan. So with a qualified plan is that, like, so you're doing it, identify your goal. Why is it that you're doing it? Is it that you're doing to save tax? Is it that you're doing to build retirement? You know, and then you seek your alternative. You know, it comes back, you know, last couple weeks ago, we spoke about mortgage, and we had Miss Lisa Lander on with us, and she was sharing some things with us about mortgages, whereas you have a 15-year mortgage, you have 20-year mortgage, you have 30-year mortgage. It's the same kind of things. There are alternatives. So it's always best to know your alternative so that your plan can be designed. But remember, it's a personal economic model. So the lines are still open. We have time to take a couple more calls. 954-792-1170. 954-792-1170. Visit us on the website financialliteracy.info, financialliteracy.info. You can email us at support@financialliteracy.info, support@financialliteracy.info. So as I says, our goal is to help you get educated. So we have come alongside, we have come in this community, we have come alongside SOFA. SOFA is a Society for Financial Awareness with one goal. One goal of SOFA is to help eradicate financial illiteracy in America. So we have come to where we can only do it one community at a time, in the sense that we know that we may not be able to fix the entire country. We may not be able to fix the entire world. But in this community, I have partnered with SOFA, and I am bringing financial literacy to this community. Some of the things that have been shared with you tonight have been stuff that you may have heard before, stuff that you may not have heard. So what I'm hoping that you took away from tonight is that instead of just doing something because somebody tells you that's the best thing, seek education. Seek education in the sense that, people perish for a lack of knowledge. So get education. Find out why is it that you're doing something, and whoever you are working with, that person is supposed to be able to design a plan. They should be able to show you something, whereas based on what you're doing, they should be able to say, well, this is your expected result, or that's your expected result. Can you imagine you go to a builder and you tell the builder is building a house for you, but they're going to tell you, well, in 6 months, come back and you'll see what the house looks like. None of you would do that house. None of you would buy that house, because if that builder is not showing you a plan, they're going to show you a plan. This is what the house is supposed to look like. And from time to time, you're going to go inspect and see if it's coming according to plan. So if you do that with your house, you do that with your vacation, you do that with other things, why are you taking these risks with your financial life? It is your financial life. This is your financial security. Let us help you to develop that personal economic model. Well, the clock on the wall is telling me that I got to get out of here. But remember, we're here for you. Visit us on the website, financialliteracy.info, financialliteracy.info. Email us, support@financialliteracy.info, support@financialliteracy.info. We have posted the previous show. This show will also be posted by tomorrow or Tuesday, the latest. So you can visit us on the website, and it will be posted on Facebook or Twitter or whatever you'll see there. So thank you for joining us, and we will see you next week. Thank you. Have a good night.
Waves 1170 has come to an end. Don't be mad.
She'll be back next week
On
www.waves1170.com.
Hubert McIntosh is a member of the Society for